guys, this is Stephen Hooley, founder of Phoenix FXC. Let's go through a quick video on how to mark up your charts in a very basic level with TradingView. So right here we've got AUD CAD, right? We're going to go ahead and learn how to use TradingView because it's a little cleaner than MT4. You can use MT4 to do these same markups, but TradingView is a little bit cleaner. So let's go ahead and start marking up. So the goal here, touch as many wicks as possible, right? What we're doing here is we're finding levels where price touched a lot, which makes it significant. As many wicks as possible. We'll just keep marking this up. Now the goal here is to be as precise as you can and touch as many wicks as possible. The more precise you are, the better your trades are going to be. Okay, just about done here. You can see lots of points where price touched a lot of different wicks. Okay, another thing, guys, we have to learn to do is find your floor and find your ceiling, okay? So finding the floor and finding the ceiling, what does this really mean, all right? Well, for this particular instance, we're finding that this is our ceiling, right? This is the highest point the market has reached. Here's our ceiling. And our floor is right here, this line over here. This is the bottom point the market has reached for the area we're looking at, okay? For the area we're looking at. We know that that is our ceiling and our floor. And the significance between this is, well, that's not to be confused with the high and the low of the day, because that's going to be a little bit different. It's just the high and the low of the area, so you know where prices is, what the levels are. Now the next thing we also want to do is we want to mark significant areas where price did something. Price reacted, price moved, price couldn't get past this, okay? And so we'll go ahead and start marking that. Right here is really clear. Price did something when it reached right here, right? Price did something when it reached right here as well. Price did something when it reached right here. And price definitely did something when it reached down here, right? Price did something when it reached this level. And again when it reached right here. Reached right here. right here, pretty significant. See, price did something whenever it hit this point. And if you look through here, you see the same thing. So what are we identifying here? Like I said, we're identifying points where the market reacted. The market did something. It turned around. It turned around. It turned around. It turned around. It reacted, right? These are reaction points. Points of failure where the market could have gone higher, but it didn't do that, right? It didn't go higher, okay? Here, it could have gone lower, but it didn't. It didn't go lower. As you can see, on this particular pair, this doesn't always happen. Doesn't always happen, but you can see these zones line up. Here it lines up, here it lines up, here it lines up, here it lines up, right? So let's take a look at some things that we have here. Let's identify more pieces that we have here. Okay, well, right here, whoops. Right here, if we go left a little bit farther, we see this extends all the way over here. Always look left. Always look left. But you can see this zone extends all the way over here. What does this mean? Well, to go into a very brief, very basic analysis, this is actually part of Wyckoff. ICT, market maker method, they're all commercialized versions of Wyckoff, which is very old, very sound method that literally just goes through cycles of the market. You can see right here, every time price came to this level, it accumulated positions, and then it rallied or dipped lower, one of the two, right? Here it accumulated, and it went up. It rallied. It accumulated, it rallied. Reached a third level, 1, 2, 3, third level, and then it distributed its position, right? It accumulated really quick, rallied for a level, dumped more. You can see that if you go left here, you still have this accumulation zone, right? Very cool how stuff like that matches up. Dumps it, goes back into the same zone. Same zone we saw over here, right? Same zone. And then boom. So how many levels do we have here? 1, 2, 3, right? You've probably heard counting levels in the market. It's pretty simple. Market maker method loves to say that it's the market maker method levels. It's not. ICT loves to say that it's ICT levels. It's not. It's Wyckoff levels. It's market cycles. That's it. The support and the resistance is where the price travels through, right? It travels through these. It breaks through these. These kind of hold price together. Think of support and resistance as the train tracks for price, as my mentor would say. And you can see these zones as just visual markers of points of reaction where the market did something. You can see it accumulated here, rallied, same, we saw this to the left, same area, accumulated, boom. Accumulated over here, dropped a little bit. Now it's probably going to rise up, right? We're kind of expecting this to go up a little more. Why? Well, because on top of the accumulation and distribution, there's more to it than just that. You can go and say, you can say that price wants to hit this zone a third time and then drop, right? So price wants to come up a bit to here. We'll change this color just so it's a little bit easier to see, right? Want to make it easy. Make it a little bit thicker for you guys. There you go. Price probably is going to want to come up in here, hit this, and then drop back down. Or it very well could go and try to rise. It depends. See, this is part of understanding marking up your charts. You don't just go, okay, the market, I think it's going to go here. you go, okay, well, I think it's going to go here, but it could also come back down. Because what it could do is it could bounce around in this zone like it was doing, right? And then it could rise. It could rally. It could have accumulated everything it needs and then come up here and create a new level. What you need to be prepared for is to react to what happens. Right here, it's pretty safe to say that it's probably going to go up to this zone again, right? So you'd say, okay, I'm prepared for it to go to this zone. And then you'd wait and see what happens in this zone. What are we going to do when it gets into this zone? Well, you're going to wait. You're going to wait and see, does it break this zone? When it breaks this zone, you're probably going to want to buy because it's probably going to rally pretty good. If it doesn't break the zone, then you want to sell. You want to probably look for it to travel down to this next zone, right? Because you can see the points where the market's going through. You can see price being held up by support and resistance, and you can see the zones, the points of reaction, the points of failure that price is traveling through. That's one thing that you have to be careful of, is don't overcomplicate the markets. Too many people try to complicate it with indicators and magic strategies. And don't get me wrong, strategies are great. Indicators are great. But you have to be careful not to overcomplicate it is all. You could even apply fibs to this. And let's see. You could even apply fibs to this and check it out. So let's see. Low for here. No, we're not going to do that. We're going to do to recent low. Okay. So here, you can easily see that it's traveling through the fibs, right? It's not able to break the 61.8. It rebounds back to the 38.2. This is a common thing. And now it's going to try to rally back up. This is part, I mean, Fibonacci is just a mathematical strategy. It's based on psychology. It's based on math. It helps. It's super helpful to determining, determining where price will travel, as well as establishing some psychological support and resistance. Basically, Fibonacci can be used from the recent high to the recent low, or the recent low to the recent high. If this had a higher high, you'd be doing it from the low to the high. But right now, it's got a high and then a low. So you do it from the high to the low. You could do it from here to here. You could do that. But I prefer to do it this way. And the cool thing about Fibonacci and different things is you can kind of experiment. You can experiment with, okay, if it goes here, what am I going to do? There's people who will plot multiple fibs. You can say, okay, here to here, what am I going to do? And here to here. You can do both. So the other things that we could plot out are channels, right? You can plot out this channel. This is pretty easy to see right here. This is a nice channel. Right? Very nice channel. Price is traveling within the channel. Price breaks out of the channel and starts accumulating for an upwards move. See, price breaks out of this channel. And it's probably going to want to touch the zone before continuing this downwards channel, right? Now, channels on top of support and resistance help you find the direction of where price is headed as well. Price travels through support and resistance. Price travels through believe it or not, channels are just diagonal support and resistance. You've seen people plot diagonal trend lines and price react to the diagonal trend lines. Same concept. Price travels, hits here, goes back down. Goes close to here, goes back down, right? Can actually tighten this up a little bit. Actually, make it about here. You can see price tried to escape right here, but it couldn't, right? So it goes here, tries to escape, goes to the zone, can't escape. Goes back up into the channel, reacts, goes back down. Accumulate, touches again. Touches again. Goes up and touches here in this zone. Touches here, finally is able to break out, accumulates enough of its position. More accumulation here, right here. Travels up, hits. Can't break the zone, can't break the channel, goes back down. Manages to break the channel, accumulate in the zone, rise back up for probably another touch to the zone. Like we said earlier, we're going to wait and we're going to see what happens, and then it will probably fall back down to the channel. Now, what are the different things that can affect this? Well, you've got news. You always need to be checking news. You've got the Wyckoff cycles. You've got a whole host of different things. You're going to try to predict as many things as you possibly can, and you're going to use the tools that we're showing you right here in your arsenal to try to make predictions, but you also have to know how to react, right? You have to know how to react. On this right here, you would have waited for this to do this, right? Touch, 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 it taps again right here, and then falls, right? Now, you're not going to enter here for a buy. You're not going to know what this is going to do. You're not going to know if this is going to fall back down, right? And try to go to this, you don't know yet. So you wait, it travels up, and then it touches here. This is where you're going to enter. Why? Because now it's made 2 touches to the zone, and it's going to want to rally back up to this zone. Support, resistance zones, we look for 2 to 3 touches. Here, 1 touch, 2 touch, 3 touch, right? 1 touch, 2 touch, 3 touch. Major touches. That's what we look for. You're looking for touches, 2 to 3 touches to establish a valid zone, a valid support and resistance, channel, etc. The more touches you have to any point makes it more valid, makes it stronger, right? The more touches you have to a support level, the stronger the support level. The more touches you have to a resistance level, the stronger the resistance level, the harder it is for price to break out. As you can see right here, this is a pretty strong resistance level. Price is having a really hard time breaking this resistance, right? Price is having a hard time breaking this zone, right? This whole zone of price, I think it's about 30-ish pips or so. Price is having the hardest time breaking this, right? Price was able to break these, was able to break these. It was not able to break this. So far, it's not able to break this. So that's how you weight your significance. That's how you place your significance on things. Is what was price not able to do, and what was it able to do? That's why I said you wouldn't enter right here, because this isn't very strong. You can see it was strong for a minute, touch, 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 and then it broke through, right? And then again here, it only touched it for a minute, and then it broke through, either way. So that's why here you wouldn't enter here, because you don't know how strong this is yet. You'd wait for the second touch, and then you'd watch for it to rally. Understanding charts, marking up your charts is giving you, don't complicate it, because it's to give you visual clarity of what price is trying to do. Some people are able to look at this naked chart right here and just understand, right, without marking anything up. But the average person needs visual help with marking things up to help give them visual clarity. So when you mark up your charts, don't cause yourself to make things so messy that you don't have visual clarity. Once you lose clarity, you complicate things, and then you start making it so that it may be even hard to find a good setup, because now things aren't very clear. Now things aren't cut and dry, right? In this, you can see it's pretty cut and dry, for the most part, right? And that's what we want to keep it to. We want to make sure things are easy. Easy as possible when trading, because trading is not an easy thing. Now, you've seen Fibonacci, you've seen some channels, you've seen points and reactions of failure, you've seen support and resistance. We've gone over what to place significance on, right? We've gone over several different things here. Now, let's say somebody showed you this chart markup, right? Let's say somebody just showed you this and you hadn't seen it, right? What do you do here, right? Okay, well here we see this chart markup. We can clearly see there was a downtrend. And we see there's an uptrend. And then we see this arrow, right? Okay, so let's just walk through. If we saw this chart markup randomly on the internet, how would we make sense of this and turn it into a setup that we can plug into our trading, right? We would say, okay, price goes down, price goes up here, accumulates, great, accumulates again, rallies for that's 1 to 2 to 3 levels, and then of course, touch, 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 drop, back down to this zone. Okay, but now it's broken out of the channel. So, do we look for a new channel, or do we look like over here for it to break back into the channel? Well, it couldn't break through the zone, but it didn't go back through the channel. It had its chance here, right? But it didn't do that. It's respecting this trend line, in fact. So, we'll even go here. It's respecting this trend line, in fact. So what do? Well, we watch. We know it's probably going to go touch this zone. Now, to decipher this, we've said this earlier in this video, you're not going to enter here because you don't know, right? But there's a second touch. So on the second touch, we're going to enter here, and we're going to go up. Would you enter here? No. Price could reverse right here, right? This could be another channel right here, and price could be falling back down. We don't know that yet. So you'd want to enter here, place your stop loss in profit, probably about here, and ride this up and wait for it to touch this zone. Now, when it touches this zone, that's when you're going to want to be looking to exit or for another fall, or to see if it rises and you can continue your trade. Either way, your stop loss is in profit, so you're risk-free. That's really important. That's a big part of risk management. But that's how you're going to manage this trade. You're not going to be looking too much about entering here at all because you can't enter here. This has already happened. You're using this historical data, literally, to figure out what's going to happen next, right? Somebody else has already done this chart markup on the historical data for you to try to understand what's going to happen next. Now we've gone through, if we're looking at this chart, how do we handle this? You wouldn't enter here, you'd wait for the rally, you'd wait for it to touch to this zone, you'd probably exit on this zone and wait to see what happens. If it were to break this, you could enter again. It's probably not going to break this. It's probably going to hit this, you're going to exit, and it's probably going to fall back down. So you can exit before or you can exit on it, when it starts to fall. Either way. So to plug that in, you'd say right here, okay, I'm going to enter, let's say here, you'd enter at 98835. Put your stop loss and profit at 99294. You'd ride this up. You'd probably get a little scared right here, but you'd understand, again, this is why we went over support and resistance. You'd understand this is a support level. It didn't break this, it held it up, and it's going to continue up, right? All of these things are considered confluences to help you. Confluences to make it easier to decide on what to do in the trade. That's really what all there is to it. In the next several videos, we'll go through more advanced techniques, we'll go through advanced methods, we'll go through more, but this is a very basic overview of how to mark up your charts, how to convert a chart into a setup that you can trade, right? So thanks for watching, appreciate it, we'll move on to the next video.